Wayne Carr from Hidden Gems Financials.
We can always do our own intro.
It's really just a byproduct of us having these conversations in the background. You have Do What Banks Do. I have Hidden Gems Financial. Obviously, we came together based on a common passion for infinite banking and just helping each other. So it just made sense to have a public conversation about the things that we talk about privately in an effort to really just educate and help the people understand what this is, why it makes sense, and how they can benefit from something that's been hidden in plain sight for centuries, to be honest.
It's interesting after 25 years in the industry how I was taught this over 10 plus years ago. And when you work for a corporation, they basically tell you have to do what they say. And even when
Yeah.
you bring something like this to them, you never understand really who to believe or who not to believe. Because you figure you work for a company, they're teaching you the ropes because you have no clue. And that's the way it should be, right? Where it's the Dave Ramseys of the world that have their spiel, right? Buy term, invest the rest, or those other naysayers about whole life being so expensive. I believed it. And I read the book, had the book in my possession for over a decade, and I still didn't understand until you actually have one yourself. So I think you and I coming together, meeting years ago, was like a blessing in the skies, I think, for both of us in a way, different paths.
Well, and it's not even so much, it's more about the perspective. Cause like you said, you read the books and everything, and they just push you further and further down that path. And it's a very skewed, narrow perspective where they put the blinders on in an effort for you not to discover everything else that's out there, which is why they put blinders on horses in the first place. So they
Yeah.
don't get distracted running down the tracks. And concept to things like buy term, invest the rest is no different. And even when they attempt to address whole life, they're not talking about the specific type of whole life and the structure that is infinite banking. They're talking about your grandmother's whole life, the Gerber policies that when they have those conversations are true when you operate from that limited lens. But when you talk about all whole life, then you can start to very easily poke holes in that argument. And I'm no different than you. When I got exposed to it, it wasn't infinite banking, first of all. When I got exposed to cash value life insurance, as they like to say, and we all know what that alludes to, I was told that if I keep selling it, that I would go out of business because obviously they wanted me to sell the things that's churn and burn that make them money, that
Yeah.
increase their bottom line, and not sell really I wouldn't even say sell, but not fit people with products and strategies and structures that truly benefit them, which is ultimately how we landed here. And again, why we are so passionate about this in general.
It's interesting because when I've ever talked to either consumers, friends, or family, or even prospects that come to us, right, when they talk, they're always talking about term and whole life. Not
Yeah.
understanding that that's not even the type of product out there, right? There's only two types of life insurance that people don't have no clue. They think it's just term and whole life without understanding that it's term and perm, right? They don't understand because they think it's for the entirety of their life, so they say a whole life, but each product underneath the permanent chassis, that's like the education part where it's bringing people back to the basics. I think we forgot that. Right? Even agents forget it too because they take a test, they study, they get licensed, and they throw the knowledge away and they just do whatever anyone tells them to do because they just want to make money. Like you said, transactional, turn and burn. And I don't know about you, but I was taught from my mentors back in the day, old school mentors, more about your client comes first, not your pocket. And if you retain the client by doing the right thing by your client, then you need to go and have more leads and generations. You just take care of your clientele just by
Right.
doing customer service. And so just it's sad that we're here today and the industry is getting so bombarded with misrepresentation about different types of products and calling it cash value life or whole life or IUL, which we'll dive into that in a whole new segment of that. But today, more about educating people on the differences, how to utilize an asset, not a product. I think that's like the terminology and the education that get people to understand when they hear those words life insurance. I don't know about you, but whenever I've talked to recent clients of mine, I'm asking them because I need feedback. That's all we get feedback.
Right.
When I say the word life insurance, how do you perceive it? Right. And I can see it on their face, but when you talk to people and your clients or your agents or family, when you're talking about life insurance, when you're out to a party or someone or hanging out with friends, how do you think they perceive that word in their mindset? Like expenses, burden, or what's your take on that?
I think for most households, unfortunately, life insurance is just an expense. It's a line item, which is why they shy away from it and tend to, despite the importance of it, And it's one of those things that's not really important until you need it. And unfortunately, when you need it, you typically can't get what you need because you're in a situation. However, it's a line item, which is why they put things like the cable bill and the cell phone bill and vacation ahead of it. When in all actuality, if you say you love your family, life insurance should be the one thing that you never let go. Because in the event that, and nobody plans car accidents, nobody plans plane crash. Well, maybe there's an argument that some people, theoretically, nobody plans those things, but those things happen every day. And if, unfortunately, if you're subject to one of those things and you lose your ability to provide for your family, or you lose your ability to just show up for your family, like we used to tell the story, if the sheriff knocks up at the table, if the sheriff knocks on your door tomorrow, to the wife and they have your husband's driver's license and say who this person is, like, what does that do for you? What does that do for your household? How do you pay the mortgage? How do you pay the car payment? Who's running back and forth to daycare, sporting events? Like, how does all that work? And what do you have in place to protect against that? And the only thing that's there is life insurance. Yes, you could have a 401, which is going to be taxed when it comes to you, or you can have savings, which is typically not enough. But why would you deplete your assets when you could leverage your dollars and multiply them almost instantly in a life insurance policy and have it pass tax free directly to you by default and put you in an infinitely better situation almost overnight? Because one thing that I've never had happen in the 11 years that I've been in life insurance is a client tell me that the check was too much, that they didn't really need it.
That's for certain. It's more about I wish I had more when the time comes. It's and that's the thing. We never think about it when life. It's just normal life because we work a job, right? It's how they taught us. Go to school, get good grades, go get a job, work for your 30, 40 years and retire and have fun. But they never tell you exactly how money really works. And if a catastrophe happened, right? What are we going to do to supplement the income and the expenses for either mom or dad or the children? We don't really think of it. We just hear the word life insurance, or we get the salespeople trying to sell you something for death benefit, right? If you die, your family gets this. So you don't get to use it. That was the mantra of that buy term invest or rest thing back in the day. And if we go way back to the foundation of whole life or life insurance, we only had one, from what I understand. We only had whole life. That was it, right? It was whole life. And I guess the thing was greedy regulations and carriers and it's business, right? Greed, where they want to try different things to make the bottom dollar for them. So they come up with those different products like the perms and then the IULs, the ULs, VULs. And it's sad because if we just had one product line or one asset of the whole life structure, then that would only be it. And we'd be doing the same thing over and over again. And we'd be using this thing like an asset, like real estate, not just the punchline for commission and sales and bad agents running around with their heads chopped off. But it's more about educating people today that this asset, infinite banking, using a specially designed whole life, is more of understanding that it's just a tool, right? It's a financial tool that we are using to move money into it first, not your paycheck. I can't do that because it's not a bank. I think the misconception, and maybe you correct me if I'm wrong, but people associate this on social media with the word investment. Am I correct? Like invest your money here. You've heard that a lot of times. What's your thoughts on hearing that stuff on social media, right? And agents saying it and clients saying it. Like, what's your take on that?
One of the first things I tell people when we're talking about infinite banking is that it's not an investment. Insurance is not an investment. But those people that say that online on social media and in all the platforms, the product, because they are product pushing, the product that they're pushing is like an investment because, and we've talked about this, because in order for it to operate properly, you have to manage it. You have to reallocate funds. You can't just put it in because it's indexing. You can't just put it in one index and just let it ride for the life of it. And unfortunately, most of these agents don't understand indexing first and foremost because they just say you can't lose. It's tied to the market, but not invested directly into the market. So they really don't understand what tied to the market actually means relative to indexing. And then if you can't lose because of market performance, then how can you lose? So it really is more like an investment
Yeah.
than life insurance should be, which is why when people say, the same people that say buy term, invest the rest, when they say, why would you have your investment and your life insurance in the same place? I understand that argument when talking about that vehicle. But when we're talking about infinite banking, it doesn't really hold up because of the separation that exists when it's structured properly.
Correct.
Because you really can't lose, not due to X, Y, and Z.
Yeah.
It's all inclusive. You can't lose. Your principal is guaranteed. There are no levers that will cause it to go backwards if this happens. As long as you maintain your premium payment, and you're going to continue to grow consistently, because when structured properly, a portion of that is going to the PUAs or the cash value, or however your client understands it, it's going there anyway. So by default, you're going to have guaranteed, all but guaranteed consistent growth. You can't say guaranteed because it's a dividend, but they haven't moved it
99.9.
over. Absolutely.
99.9, because they never missed a dividend for hundreds of years ever. And we're talking about through the test of time, the Cold War, Civil War, 9/11, COVID, like you got paid a dividend. I think where we go with that is when we're talking to our clients and prospects, it's more of when you say that word, like we've gotten paid dividends. Now the brain of the psyche goes to, oh, what's the dividend rate? As if that's the importance of an
Well,
investment
because they're thinking of it
question.
as an investment.
Correct. And we're think it's good for us to come together and being the first podcast, let's just say getting our feet wet, right, under the ground is more about bringing it back to the basics to keep reiterating to everybody, this is not an investment. It's not an investment. So when we hear it on social media, it's the worst place to invest it. You're 100% correct because there's no risk here. You're not investing in the stock market. You're not investing in those IULs like an index. Like this is a modern whole life take where we can design these things very differently than people understand. And it's not like every carrier can do it, right?
Mhm.
It's a select few that are mutually owned. So it's like taking it back to the basics to just keep re-educating people. These are not investments. So it's not FINRA, it's not SEC regulated. These aren't in stocks. Like you're getting a dividend, 4, 5, 6%. Let's just say you get it every year to the day you die. Like that's consistency. Whereas there's no zero is your hero. You're never missing it, right? Like they say the average return, like there is no average return. We can have plenty of topics on these discussions you and I have, but it's more
Yeah,
about, but it's just what's the dividend? I don't know. I like to return the question. Like I always like a reflection mirror image where they ask me what the dividends are, and I always ask the client, well, what are you getting in your savings account right now? Is that
absolutely.
1%? And the questions, excuse me, I'm all about asking questions for people because I want to see what their mindset is. And if you're spending money out of your savings account or emergency fund, is your bank going to give you any interest on the money you just spent? So and I think when you tell them that, they don't understand when I say, well, I'm borrowing money from an asset instead of a policy, an asset that I'm still earning 4.5%, 5%, or even 6% on the money that I borrowed as if I spent it at Bank of America and gone. It doesn't equate because we never got taught how money really works in leverage, in an asset that you can leverage. I think that's where it is. It's an asset, not life insurance. It's leverage, not dividends. Right? And I think that's where everyone just has to keep understanding these are not investments. Stop listening to people that say it's an investment. It's just a way to store money. I think, in my opinion, first, right? Before we go out. So if it's just like a cycle, it's as if I got a paycheck, it goes into my bank, and then I take the extra surplus after my expenses are paid into the policy that we, like you said, we structurally design it properly to make room to
Mhm.
build it. And then when we need access to the money, yes, we borrow it back. And it goes right back into the cycle of the policy to invest it then if we want to, or buy items or pay expenses or credit cards or debts. I think when we say the words like borrow, what do you think comes to people's minds next on the question? Like, hey, I borrowed money from the policy. What do you think they ask after that?
Obviously, then they wanna calculate the loan rate, and now they're calculating the loan rate versus the dividend, just again, which is a very narrow perspective. Going back to what you said before, even when you talk about what the dividend is, if you're calculating it and comparing it to a savings account, not only do you have to consider what you said, what happens when you pull money from the savings account, but your savings account isn't an appreciating asset. So it's not going to continue to grow in value despite you borrowing money or pulling money out of your savings account. The other thing is that with that being a narrow perspective, you're not considering what you want to do with that money. So yes, you're getting a dividend here, but then you also went and bought another appreciating asset, a property, or went and bought a car that you can turn that generates revenue,
Yeah.
or went and paid down a credit card in exchange the interest rate of 6.5%, which is what it is now, exchange a 6.5% interest rate in your insurance policy, leverage those dollars that are still earning a dividend and bought down an interest rate of 18 to 28%. So that's a narrow-minded perspective. And they turn around immediately and ask, well, what's the loan rate? And why so I'm paying to borrow my own? No, you're not
Yeah.
paying to borrow your money. Your money is sitting safe in the bank's coffers. You're borrowing from the bank, which is why they continue to pay a dividend. And now you're borrowing the insurance company's money to go continue to live your life, to increase your lifestyle or maintain your lifestyle now and allow your money to continue to grow for your future. The other thing with the whole savings account versus insurance policy mantra is, if you have $100,000 in your savings account, you borrow 20. Now they're only paying you interest on 80. You do it in a policy, like you said, they're paying you on the full 100. Not only that, but the interest that they're paying you, they're going to 1099 you for that at the end of the year, versus the dividend that you get in your insurance policy is going back into the policy and paying you a dividend on top of the dividends that you just earned. And then the end all be all to me is, if, again, going back to the general life insurance example, if you have $100,000 in your savings account, you get in a car crash today and you have to take 6 months off of work, or you become disabled, critically, chronically ill, or even pass away, you only have $100,000 to work with. Put $100,000 into an insurance policy structured properly. Now, just being extremely modest, that turns into $750,000, $1 million for your family, and then living benefits for you to pull from in the event that you still need to maintain your lifestyle. And that dramatically changes everything just
Yeah.
by, again, managing your cash flow differently.
That you hit the key word there, cash flow. 'Cause people don't understand, which we're trying to educate them, which takes time. It's not overnight. But when we're talking about cash flow, it's who controls it. Are you going to let the banks control your money, or are you going to take control of your money? Right. And that's the whole point, is if you have your money, your capital stored somewhere else, not all of it, because you can't put your paycheck in these things. Right. But when you have your money stored here, like you and I do on these policies, and we can have as many policies as we want relative to our income and our net worth, right? We have some of these things on our children for their college, and we can, that'd be a whole nother conversation for later. It's more of, where can I store my capital? And yes, like you mentioned before, you pay a premium. Now, I think of my premiums as deposits going into my own bank. And it's like, well, if I pay $300 a month for my checking account at Bank of America, well, now I can go ahead and store, let's say, 20 plus thousand extra into my savings account if I want to. And if there's a cap in my Bank of America savings, that's fine. But it's like I'm paying $300 to maintain my checking account to pay bills. And now I can put it at 20,000 in my savings account. But the key is, if I can borrow money from that 20,000 and still earn dividends on the same time that I borrow all of it, wouldn't you just want that from the bank if they offered it to you? Anybody would. The problem is, banks don't do that, because banks are the largest holders of these types of whole life policies, not IUL. And the key is this: some carriers, they have the right to adjust your dividends on the money you borrow, right? And that's very tricky, because that's where you and I understand, with certain people on social media that push the carriers for the dividends rather than, and the loan rates being low, rather than understanding it's very easy. I want a place I can store as much money as I can every year, not just one. I can have access to the majority of that money that I put into it whenever I want to at any time. No credit check, no background check, no waiting in line. 7 days or less, the money comes back, direct deposit, or mailing a check. The key is this: I want to still be able to earn dividends on all of the money, whether I borrowed or not. No adjustments. I think that's the key thing that a lot of even IBC guys out there, right, on social media, they talk more about the numbers, and me, I'm more about concept and philosophy.
Absolutely.
That's my structure. Like, so when clients come to me about dividends and interest, loan rates, arbitrage, I just flip the question back on them and ask them what the other carriers are doing, why they're offering this, and what are you trying to do with your money? Right? That's like, let's get to know you. Like, so we're not, you and I think we're both from the same cloth, just different parts of the world, but it's more about, let me find out more about you first, not just what I want to do. And social media, I don't know about you, ask how I feel after watching a lot of these videos over the years. Even IBC, it's more about turn and burn, transactional. Let me show you numbers, illustration, and let me just get you here so that we can have one of our mentors or agents, advisors, or whatever they're calling these days, have a strategy call and just tell you what you should do with your money just from watching a clip, instead of getting to know you, like your life, right? Your family, like,
No, it's laughable that they call themselves financial advisors, because they just got an insurance license and then started talking about IULs, because that's what lured them to insurance. Come earn six figures selling truckers IULs or selling veterans IULs, when they're literally the worst things that you could do to those people. And it's saddening, and which is why obviously we have to do more and promote the other people that are having very similar conversations. But it's just, it's tragic what they're doing to people. But you said something, and I want to talk about it as an asset, because when people think about assets, the first asset, the American dream, is buying a house. And when people talk about building equity in a house, they talk about building equity in a house to leave it to the next generation, or then they take out home equity loans and line of credit. And this is very similar, and use this a lot when I'm talking to clients. This is very similar in the fact that it's going to continue to appreciate. It's an appreciating asset. As long as you maintain your premium, just like over here, as long as you maintain your mortgage, theoretically, unless the housing market falls, and that's the thing, there's volatility in the housing market where your value goes up and down. Here, you don't have that. As long as you maintain your premium, that asset is going to continue to appreciate. And
Yep.
which is why banks buy these, is because, and I learned this from you, it's a tier one asset. So they can hold it on their balance sheet because there is no risk, because it's going to appreciate in value. And that's why they don't buy IULs. So when somebody says, do what banks do, and then they turn around and sell you an IUL, that's classic bait and switch, which is the issue that I have with them saying that and saying things like what the Rockefellers do and cash value insurance and all these ambiguous things that they say that lead them down the path of this. And then in the 11th hour, they pull the rug out from under them and then show them that, because wow them, which speaks to what you said. My thing too is selling is not even selling, but having you understand the theory and the concept. Because if you can understand that we're maximizing cash flow, truly allowing you to use the dollar more than once now within 30 days, as opposed to 5 to 7 years
Oh
down the
yeah,
line, which is a
tremendous.
completely different conversation. Like, we're not setting aside money, we're just managing cash flow. Then I put you in a better situation. And we're not concerned about that payment as much, because what you would see once you understand the concept, and we do look at the illustration in black and white, you would see that you're really only paying that premium for 3, 4 years tops. And then after that, the dividend eclipses it, and you start to get a cash on cash return, where not only is your dividend more than your annual premium, so it becomes a wash, but that same amount, say $20,000 that you're putting into the policy a year, your cash value is increasing by $20,000 or more.
More,
Who
much more,
who
3 times.
Absolutely. Like,
Yeah.
who listening to this right now has an insurance policy that they pay 3 or 4 years and they have for the rest of their life, and it continues to increase in value? Because that's essentially what this is.
It's an
But
estate plan also.
now I want you to speak more too, because I just talked about the house, but it as an asset.
Oh, no, that's
It
fantastic. Could you and I we go round in circles because you and I say the same thing over and over again with agents because it's new people, new clients. And it's amazing because to us, it just feels like routine. But to someone new who's never heard of it, that they've never seen it that way in that perspective
Sure.
with the house. Because these whole life, these special whole life policies, I just call them modern whole life, let's say, or call it whatever it is, a hybrid or whatever anyone wants to give it the title of it. But it's just a special whole life policy, right, from a mutual company. But designed properly, like you said, it's like real estate. It's an asset. So in real estate, just for anyone listening, if you own a piece of property and you pay $300,000 for that property, and today it's worth 500,000, well, there's $200,000 of equity in that property because it appreciates every year. So the bank's not going to give you 100% of that equity, right? They want some leverage. So what they'll do, let's say, is if you want a $50,000 line of credit, I'm sure they'll happily give it to you. That's 200,000, not a lot of room. The difference is you still got to fill out those 50, 100 pages,
Oh,
right, at the bank, the application, 1099s, W-2s, tax returns, wait in line to see if you get qualified, right? They want to see if you're good liability, debt to income. And then let's just say you get that $50,000 home equity line of credit. That's all it is. It's a HELOC against your property. And you just borrowed 20,000 to fix up your bathroom and your kitchen. Great. Now, you're still on a new payment plan. You still got to
mhm.
pay the bank. And if you're late, there's late fees or your credit gets shot. And you're not earning any interest on that $20,000 you just borrowed. You got to pay it along with your mortgage. And the reason why the bank is going to give you that line of credit is because they know if something happens to you, they can sell the property, right? Your family could sell the property for more than it's worth. Okay. And that's your collateral. So we're talking about an asset that's used as collateral, which is the 600,000. Now, switching the gears to the life insurance that you and I have that we've set up for ourselves, our families, our generation, and others, is that's the asset we have. And if we're paying $300 a month for the quote unquote mortgage, like a house, because everyone pays the mortgage, they don't earn nothing on it, they pay it interest. majority of the time. And then I have 20,000 sitting in my bank account for emergencies. Now I have to build my own equity. So life insurance is different because we're building our own equity, our own line of credit. You can't borrow the death benefit because that's why we're playing by different rules. We're not playing by financial rules anymore. We're playing by life insurance rules. You qualify with your health, not your finances so much. So, what people understand is we have a death benefit that is our new collateral. So, the property's value is the collateral to get you the equity. And now the life insurance death benefit is your collateral. You can't borrow that. You can't borrow free money. You can only borrow what you put in. So, you're building your own line of credit. I like to say it's like the life insurance line of credit, right? So now if I put in 20,000 like I did the first time I was the guinea pig for the agency, I was able to borrow, let's say, I think it was 16 or something $1,000 back from that piece. Right? Because you can't borrow dollar for dollar. It's a tax shelter. Right? Come on. So now when you get the $16,000 back, I can fix up my property or my kitchen and bathroom. But now I'm earning dividends, whether they're 4, 5, 6% on the same 16,000 that I just borrowed. And you can't say the same thing with the HELOC. And the reasons why people can't understand that is because they forget that one key thing I said. If we pay the premiums, 300 a month on our policy, like they pay their mortgage on their house, when we pass away, the company, life insurance, must pay a death benefit. Our collateral. So if we borrow money out, which you and I have definitely borrowed money from our policies, and we've used this thing like, I don't know, I've used mine at least 100 times by now, 5 years. Well, guess what? If I don't even pay it back because there's no payment schedule and no credit check, no background check, no waiting in line like a HELOC, nothing. I decide how I want to make the payment plan back. And people can understand, how's that even possible? It's
Right.
possible because I'm using the collateral of my death benefit, like you said, that keeps growing every year as I put money into it. Right? And I'm also increasing my line of credit. So when I pass away, if I've never paid the loan back, like I already haven't, or on money I have,
Right.
just take it from the death benefit. And the rest goes to my family tax free. So now we're playing by different rules. The collateral, we just got to find a place to store our capital, but we have to be healthy ish, right? That's the pros and the cons. So if we can stop people from thinking about the word life insurance as an expense and think of it more as an asset, right? And leverage. I think that's more of the re-education of the mind, retraining the brain. Because I've asked my clients recently, I had a couple of them yesterday to save the policies that were going to lapse, is they were thinking about this as an expense. $600 a month is what one was paying, and $250 was one that was hard for them, that they own an air conditioning company. And I was just telling them I saved them and I saved the policy by restructuring and giving them the customer service they deserve, right? Because
Sure.
the agent fell off. It's fine, took control of it for them, but showing them how to retrain their mind because they were putting money into a 401k, but they don't think that's an expense, right? You- You're putting money into a 401k that you haven't touched in 5 years. You worked for the company. You're losing money. You got to pay taxes and penalties if you're drinking at 59 and a half, but you don't see that as an expense, but you're in debt paying the minimums up to your eyeballs. Like, I don't know, I'm curious. I want to know your thoughts. Would you rather, because everything today on social media is all about TFRA, tax-free retirement, right? The IUL, tax-free. Look at these illustrations. Do you care about your retirement in 30 years if you die before you get there? Or would you rather be debt-free and stress-free today while you're living? I don't know, what lifestyle would you rather have when you're retired?
Well, debt free, stress free today for sure, especially knowing that I have that windfall in the event that once I become debt free, stress free, that I don't build for retirement. I still have that windfall if I don't make it to retirement. Obviously, if I'm going down that path, I had a mind shift in regards to the way money works and how I'm going to leverage money. So once I get debt free, stress free, I'm going to start building for retirement. But now I have the peace of mind of knowing if I don't make it, I have this life insurance policy in place that's going to take care of my family in the event that I'm not able to. And just want to touch on this, and then I think we should probably get out of here because we just vibing it on everybody. In regards to that example that you gave about the house and just maintaining your mortgage payment versus the premium, that's exactly why. And this goes back to the education and the way you think about life insurance. That there's a term called mortgage protection, which by definition and by the overall general public's understanding no longer exists because that was credit insurance based on the credit. And now they've shifted mortgage protection to mean an insurance policy to protect the mortgage when it was always a life-changing event that should have necessitated you reassessing your need for life insurance, which so now they say mortgage protection to protect the mortgage. And it's really just life insurance. And this is really the best type of mortgage protection you can have because when you have this and understand it, there's no need to put extra money on your mortgage anymore. That extra money should be allocated here because, like you said, when you need the money, you're likely in financial hardship. And because the only way to access the equity in your house is by going through that arduous application process and essentially requalifying to access the equity that you've built in this asset, because it's not an asset until you've paid it off in full. But to leverage that asset, you basically have to go through that application process again. So why not put the money somewhere where you have unbridled access to it, complete control to it, and in the event that you need to access it, it's there for you to access without disrupting the growth because it continues to appreciate in value. And still, you pass away, now the house gets paid off anyway. So that mortgage protection that people are marketing, this is really the best way to do that too.
100%. Like you said, mortgage protection, because the way we design these, we didn't get into the infrastructure, right? The semantics of like today's like number one, just to give, and like you said, we vomited a lot of information, which people are still going to have questions about.
Let us know what you
Yeah.
want to talk about, dig deeper on, because
There's a lot of stuff, a lot of questions, a lot of pros and cons to a lot of people asking because they've been doing the same thing over and over again, right? Like the forum, we have advisors, we have life insurance agents, the Primerica people, the PHP people, right? The other three-letter companies out there that are thinking that they know what they know when they don't. I've been in this game over 25 years. Wayne's been well over a decade or so, 15 plus years. And it's more about taking the mindset that we both have and the education we have and the history. It's not just infinite banking that we have a whole encompass of financial services. When it comes to estate planning, tax mitigation strategies, long-term care planning, which a lot of this stuff with this policy that we're talking about, the whole life structure encompasses all of that. Like you said, chronic critical, long-term care stuff, estate planning, 3 to 4x your money. So if people want to see this as an investment in their mindset, there's no investment side by side that you can put in, let's say 6 or 7 thousand a year to a Roth IRA, which is a good idea. Which we can talk on that as well, because there's a way to have your money work in two places, right? Than one, which you and I do it anyway, we know, but where you can go ahead and put that money for 30 years. And if you never touch it side by side from apples and apples versus apples and oranges, there's no way that this money right here, right? Over what, almost $200,000 in 30 years doing the Roth IRA, when you die, is going to have even, let's say, 400,000 or 500,000 for that compounding effect of the rule of 72 and average returns on this side. But over here, you have over $750,000 for your money. I don't know about you, but which investment would you rather have? Just on the numbers, all right? 500,000, quarter, three-quarters of a million, and using this asset 30 years, never touching this asset. There's so many things we can talk about to educate people on this asset by
Wait,
itself.
there's
But
one more thing that you
yeah.
mentioned before we get out of here that I want to touch on. You said average returns earlier, and you said average returns again today. And I know we talk a lot about the fact that there's no such thing as an average return.
Nope.
And I have my theory on that. And I typically use a treadmill analogy. Like if you set the treadmill at 7.5 or whatever they're illustrating IULs at now, if you set the treadmill at 7.5 and you're going and you're at minute 3 and you catch a cramp, which is the equivalent of the market tanking or the market adjusting,
Yeah.
and you're still on the treadmill, like what happens if it's still going at 7.5? You fall on your face, right?
Ellie.
It's the same thing that's going to happen to your IUL. And I know you explain average returns a little bit differently, but I just need them to understand that average return is really
It's a
it's an
made up.
oxymoron.
It's like it's a made up version from a long time ago where people just financial institutions used it for their incentive, like their benefit, because they take like they say take the average of the S&P over the last decade or last 50 years or whatever it's been established from, and if it says 11%, it's almost as if you're gonna earn like you see you see it on social media like compounding interest those words, and they're saying if you're 30 years old and you put in like $1,000 a month, right, or even or $100 a week or whatever it is, and you have it in the S&P, and over the course of that you're compounding at, let's say, 7 or 8% or 10%. The whole definition of compounding interest means money on top of money without any interruption or volatility. So how do you compound money on negative? I don't get it. I don't get so when someone says average 7%, you didn't average 7%. So we can dive into that to explain the differences, because I have all the other naysayers out there because I did a couple of videos about you have dollar cost averaging, you have this or that. Well, if you want to get into semantics, you haven't even done the fees that they charge you, the front end, back ends that you have no clue, the taxes you might incur for capital gains or something like that, 10% penalties if it's in a Roth IRA on gain. You take the principal, but there's still penalties if you're in 60. right? So it's a lot of different variations that people don't understand. They just look at one thing, or the influencers that have 2 million followers, but the guy's never done finance ever. He just read a book or followed somebody else and stole it, or AI, and they just published it as if it's reality. And then it's sad because here we are in the field, in the trenches, actually doing the physical work, but we're working. They're just on social media. And we can help people in reality, not fantasy land. That's and we can touch on IULs so that we can really put the fear into people, and not fear as in we're trying to sell on fear, but fear in the way of exposing and understanding. Because I don't know if you still have them, but I still have my 2 IULs, and I hate them. And you don't know unless you have them.
No.
So it's a good thing for you because I was taught from the senior vice presidents at the company that sold me this for me and my son and I. Right, he's 6 now, so we've had it for almost 6 years, and I had 3 years of zero on those IULs. So they're not what they look like, and that's what we need to make people alert about the reality of how those work, because that is going to be almost the next boom that I see coming in the next maybe 5 to 7 years, or even sooner. It could happen even sooner. But we need to protect people, and I think that's what this podcast is really trying to do, is educate people on, we're not trying to sell you anything. We're trying to educate you. And if you are open-minded, and if you come to us with questions and not be defensive, I think that's the best course of action. And that's all I ask people to do, is just take it with an open mind, try to see if you can re-educate and retrain your brain. And Wayne and I will definitely answer some questions and get you guys caught up, because we live it, we breathe it, we have reality, not fantasy. We have it. We're transparent. I think that's what I'd like this podcast to be, or this new foundation of relationship.
No, absolutely. Just want to help people and as many people as possible. So just that's the gist of it. I'm glad we jumped on. Obviously, we'll continue to do this on a consistent basis and take some of the people's questions and just help as many people as we can.
Definitely. Feedback helps. No, love to hear the feedback. Appreciate everyone from listening, and hopefully we can get more of these going and get on a routine. And maybe we'll have episode 100 coming up in the future.
Coming soon, episode 100.
All right. Thank
All
you.
right. Have a good